And welcome back. Today, we're breaking down the market impact of the U.S. strike on Iran, how stocks are reacting, and which sectors are now under pressure or benefiting in this heightened geopolitical environment. First, a quick summary of the situation over the weekend. The United States and Israel carried out military strikes on Iran, killing Iran's supreme leader and escalating tensions across the Middle East. That has triggered immediate responses from Iran, raising concerns of broader conflict and oil supply disruption. Now to the immediate reaction of the stock market. Markets hate uncertainty, and this is uncertainty on a global scale. U.S. stock futures open sharply lower, with the Dow, S&P 500, and Nasdaq all selling off as traders cut risk exposure. Investors are pricing in risk-off sentiment, moving out of equities into safer assets. One of the biggest impacts we're watching is energy markets. Oil prices have shot up sharply as traders fear disruption through the Strait of Hormuz, a passage for about 20% of the world's oil. The United States Brent Fund, or BNO, has been climbing, as well as the WTI, which engages in production, exploration, development, and acquisition of oil and natural gas properties. Analysts warn prices could test levels near $100 per barrel if flows through the strait are restricted. So here's why this matters. Higher oil directly feeds into inflation, boosts energy company revenues, and raises production costs for broader markets. The sectors now benefiting are energy and oil stocks. Higher crude prices lift integrated majors, and energy producers benefit, including companies like Chevron. Defense and aerospace also benefiting. Defense budgets rise on conflict fears. People tend to turn to safe haven assets, including gold or assets like GLD. GLD tracks the gold spot price less expenses and liabilities using gold bars held in London vaults. Now to sectors under pressure. Travel and airlines. Airlines like American Airlines. Higher fuel costs and fewer leisure travel bookings weigh in on those stock prices. Riskier growth plays like tech. In uncertain times, capital shifts away from high beta tech more into defensive plays. So in the end, what does this mean for traders? Here's the bottom line. For your trading strategy today, expect volatility to remain elevated. Energy and defense sectors may outperform on strength recently. Many consider safe haven plays during risk-off periods, but keep in mind, if tensions de-escalate, markets could snap back quickly. Hit subscribe and ring the bell to stay ahead of market moves driven by global events. Drop a comment. What stocks are you watching in this geopolitical sell-off? We'll see you next time.